Welcome to Iron Financial, the show where we forge stronger portfolios by stress-testing market narratives. Today, we're putting a giant under the microscope. Altria, ticker symbol MO. This company is a legend, a dividend king that income investors swear by. But let's be real, it's also at the epicenter of an industry that's being completely reinvented. So we're going to dig into the numbers, the reports, the data, and put this thing through a proper stress test. We have to ask, is Altria a fortress built on solid financial bedrock, or is it a legacy giant standing on shifting sand? Let's get into it.
And this is the question, right? This is what it all boils down to. You look at the screen and you see a dividend yield that's pushing up towards 7%. In a market like this one, that looks like a fortress of returns. It looks like a bulwark against all the volatility out there. It just screams stability and income. But let's put our skeptic hat on for a second. A yield that high can also be a warning flare, not a guiding lighthouse. The market rarely, if ever, gives away a sure thing for free. So the real question we need to unpack today is whether investors are looking at a rock-solid opportunity or if they're about to walk straight into an elegantly constructed value trap.
Okay, let's start with the bull case. The argument for why Altria is still a core holding for so many savvy investors. You can't even begin to analyze this company without first acknowledging the sheer financial force of its dividend. I mean, it's a powerhouse, and it's fueled by an incredibly profitable legacy business. For a lot of people, this isn't just part of the investment thesis, it is the entire thesis. So let's examine the foundation of this dividend fortress, and I mean brick by financial brick.
And here it is, the cornerstone of that fortress, a 6.9% dividend yield. Now just let that number sink in for a moment. To put that in perspective for you, that is more than 4 times the average dividend yield of the S&P 500. You know, in a world filled with speculative growth stories and promises of profits way down the road, this is tangible. It's real cash paid out to investors quarter after quarter like clockwork. This isn't some pie-in-the-sky projection. It's an annualized return backed by an absolute gusher of real cash flow. For any investor focused on building a durable, income-generating portfolio, a number like this is the bedrock. It's the kind of yield that provides ballast in your portfolio, helping you ride out the inevitable market turbulence.
So, you're probably asking, how on earth can they afford to pay a dividend that high? Well, this right here, this is the engine room. Just look at these margins. We're looking at the adjusted OCI margin, which is basically a measure of how much profit the company makes from its core business. And these numbers, they are absolutely staggering. The smokable segment, which is led by the undisputed heavyweight champion Marlboro, operates at a 61.6% margin. That means for every single dollar in sales, they are generating almost 62 cents in operating income. It's just incredible. Then you look over at their traditional oral tobacco with brands like Copenhagen, and it's even higher at 67.8%. These are the cash machines that fund everything else. This incredibly profitable, deeply entrenched business generates the immense cash flow needed to fund that massive dividend, to pay down debt, to buy back stock, and most importantly, to finance their entire transition to new products. This is the solid foundation the bulls are always pointing to.
Okay, a solid foundation is great, I get it, but let's apply some pressure here. A foundation, no matter how profitable, no matter how solid it seems, is completely worthless if the ground underneath it is eroding away. You can own the most profitable horse and buggy whip factory in the entire world, but it doesn't matter one bit when the automobile comes along. So now let's turn to the other side of this analysis and look at the very real cracks that are starting to appear in this so-called fortress. Let's see what happens when we apply some real pressure. And here it is. This is the crucial point. While those profit margins are incredible, this chart shows the reality of the top line. The company's revenue for the quarter was down 3.0% compared to the same quarter last year. And this isn't some one-time blip. It's part of a well-documented long-term trend. That cash machine we just talked about? Well, it's shrinking. And critics argue, rightly so, that you can only squeeze so much profit out of a declining revenue base. At some point, the math just stops working. This is the first, and I'd argue the most significant, crack in that fortress narrative. You simply cannot grow your earnings forever if your sales are consistently falling. This is the erosion that the entire bear case is built on.
And look, this isn't some fringe opinion I'm cooking up. The market sees it clearly. Independent analysis from financial data and analytics platforms like Intellectia.ai points to this exact weakness. Their analysis notes, and I quote, "Revenue is expected to decline, indicating continued reliance on traditional cigarettes." This really gets to the core of the bear argument. The company's fortunes are still fundamentally, deeply tethered to a product category that is in secular decline. There is no amount of financial engineering or margin optimization that can hide that fact forever. The fortress might have high walls, but the world outside those walls is changing fast, and this decline is proof that the old business model is under siege.
The siege is the perfect word for it. And this is exactly where the bull case pivots. The argument isn't that the legacy business isn't declining. I mean, come on, everyone agrees on that. The real argument is that you don't survive a siege by just hiding behind the walls. You survive by building something new, by adapting, by innovating. And this is precisely why this next section is so critical to the entire bull case. The claim is that Altria isn't just sitting back and milking a dying cash cow. They are actively using the immense financial strength of that legacy business to execute a detailed, well-funded blueprint for a smoke-free future. They are, at least in theory, rebuilding the entire company from within.
And this illustrates that mindset shift perfectly. This is taken directly from the company's own annual report, and it reads like a brand new mission statement. From tobacco company to tobacco harm reduction company. Now you might ask, is this just clever marketing? The bull argument is that it's so much more than that. It's a public declaration of a fundamental strategic pivot. They're signaling to the market, to consumers, and frankly to themselves, that the future is not in combustible cigarettes. They are using the massive profits from the old world to build a bridge to the new one. This frames the change not as some panicked reaction, but as a deliberate, long-term transformation.
So what does that transformation actually look like on the ground? Well, here's the blueprint itself. It's not some vague idea. It's a concrete, three-pillar strategy designed to compete in every single major smoke-free category. First, you've got NJOY, their big bet in the absolutely massive e-vapor space, which they are rapidly expanding into over 100,000 stores nationwide. Second, you have ON, their oral nicotine pouch, which is their fighter in one of the fastest-growing consumer segments out there. And third, there's Plume, their heated tobacco product, which represents the next wave of innovation in the space. The whole idea here is that this is a comprehensive, multi-pronged attack designed to completely rebuild their product portfolio for the next generation.
And if you want hard evidence that this blueprint is actually starting to work, the bull case points directly to this number right here. This isn't a projection, it's a reported result. The ON brand saw its shipment volume increase by more than 40% in 2024. That is explosive growth, and it proves they can build and scale a new brand in a totally new category. But maybe even more importantly, the division that manages these new products, Helix, actually reached profitability in the fourth quarter well ahead of their own schedule. This is such a crucial milestone because it shows their new ventures aren't just a cash burn, but are on a clear path to becoming self-sustaining and eventually very profitable centers for the company.
40% growth is impressive, there's no denying that. But let's get real. Growth never happens in a vacuum. A blueprint is totally worthless if your competitor is building a skyscraper next door while you're still pouring the foundation. Altria isn't the only company making this transition, and frankly, they are far from the biggest player in this new game. So sure, internal progress is great, but it becomes irrelevant if you're losing the war externally. Now, let's talk about the competition.
Yeah, let's see how this builds a very different picture. That 40% growth for ON is a great talking point. But here's the stark reality of the battleground. On the other side of the field is Philip Morris International, Altria's former sibling company, with its brand Zine. And Zine isn't just a competitor, it is a cultural and market phenomenon. Analysis shows it's the most popular smoke-free product in the entire US, and by some metrics, it holds over 70% of the market share for oral nicotine pouches. So while Altria is celebrating its growth, it's growing from a much smaller base and is basically playing catch-up in its own backyard. This isn't a healthy rivalry. This is a dominant force that Altria is struggling to contain. The big question from skeptics is, can their blueprint ever be successful enough to overcome a competitor with such a massive, entrenched lead? It's a serious question.
That's a fair and critical challenge. The competitive landscape is absolutely brutal. But this brings us to the final, and I think perhaps the strongest pillar of the bull case. The argument is that this stress test isn't just about who has the #1 nicotine pouch. It's about the total return proposition for an investor. And while Altria is fighting that competitive battle, it is simultaneously using its immense financial power to forge direct, undeniable value for its shareholders. This, the bulls argue, is their ultimate defense, their ultimate trump card.
Let's start with this number. In 2024 alone, Altria returned over $10.2 billion to its shareholders. Let me say that again, $10.2 billion. To put that in perspective, that's a combination of roughly $7 billion paid out in those powerful dividends we talked about, and another $3.2 billion used to buy back their own shares. This is not a small sum. It's a staggering amount of cold, hard cash being put directly back into the pockets of the people who own the company. In an environment of uncertainty, this is a tangible, powerful reinforcement of the company's financial strength and its stated commitment to its investors.
And this commitment isn't some new strategy they just cooked up.
It is deeply ingrained in the company's DNA. They've raised their dividend 59 times in the last 55 years. Just think about that track record for a second. It spans recessions, market crashes, countless regulatory battles, and massive societal shifts. And through all of that, the dividend has not only been maintained, it has consistently grown. Proponents argue this demonstrates a corporate culture that prioritizes shareholder returns above almost everything else. This isn't a short-term tactic to prop up the stock, it's a long-term, durable philosophy.
And they are doubling down on that philosophy right now. On top of everything else we've discussed, the board just approved a new $2 billion share buyback program. Now, what does a move like that signal to you? It's a clear indication from the people who know the company best, its management and its board, that they believe their own stock is undervalued. They're not just saying it, they are putting billions of dollars of company cash to work buying their own stock. This not only supports the stock price by reducing the number of shares out there, but it also signals immense confidence that their smoke-free blueprint will ultimately succeed. They are putting their money where their mouth is.
All right, we've laid out the evidence from both sides of the argument. We've stress-tested the fortress of the dividend, we've examined the cracks in that declining revenue, we've analyzed the smoke-free blueprint, and we have sized up the brutal competition. Now it's time to step back from the debate and synthesize a final verdict, summarizing the core of the bull case and the core of the bear case based on all the data we've explored. So, the bull case really boils down to this. You have to respect the structure they've built. The financial foundation, anchored by those incredible profit margins in the legacy business, is seen as rock solid. That foundation generates the cash to fund an exceptional dividend and aggressive buybacks, creating a powerful current of shareholder returns. And yes, the company faces major headwinds and fierce competition, but their smoke-free blueprint is showing real, tangible progress. The argument is that they have the capital, they have the strategy, and they have the discipline to manage this transition. For the patient investor, this is a fortress built to deliver.
But on the flip side, the bear case is equally compelling and demands caution. The blueprint looks good on paper, and yeah, the early growth in their new products is encouraging, but it may not be enough and it may not be fast enough. The company is in a race against two clocks, the steady, undeniable decline of its core business and the explosive growth of its main competitor. The execution risk here is massive. They have to successfully scale multiple new products in hyper-competitive markets, all while their primary profit engine is sputtering. The fortress is standing today, sure, but the ground is shaking. And if that transition plan stalls, critics warn this fortress could absolutely crumble. The potential for this to be a classic value trap is very, very real.
And so that brings us right back to the central question we asked at the very beginning. Based on all the analysis, is Altria's massive dividend a reward for an investor's patience, a sign of faith that management will execute its plan? Or is it a tempting warning sign, masking the significant underlying risks of a business in a monumental, high-stakes transition? We've given you the framework, the numbers, and the core arguments from both sides. The final call is yours to make. Thanks for tuning in to Iron Financial.